Welcome back everyone to another episode of My Financial Climb. Pretty excited about today's video. It's a video that I've been wanting to do for quite a while now. It's kind of the premise of doing this whole channel and documenting my journey. And today I'm actually going to share the 401k that I've been promising for a while now. I had to do a couple videos to lead up to that. Hadn't done it quite yet, and now I think today is the day where it's time to finally officially reveal it and kind of go through and talk about it. Part of me making this video, this was a video I had an idea of doing way back before I even started this channel, because I wanted to make sure that I was transparent and had everything disclosed, and this video is kind of proof to show you exactly how much I'm willing to show you guys and be transparent with you all. So that's kind of what we're going to be doing today. We're going to be going through it. We're going to be looking at things that I look for, how I navigate through mine, things that I monitor and look for. So that's kind of what I'm going to be doing today. Now, a couple things before that, are a couple, precursors or caveats or whatever you want to call it, that I want to go over and discuss before we go into that, is that I want to make sure that that I at least say that I'm not going to have a 401k that's set up like everybody else's. Everybody else is going to have different 401ks depending on how your employer has set it up. So mine may look a little bit different from yours. Mine may look the same as yours. It all depends. So that's number one. Number two, I'm going to be a little bit more aggressive with all my goals. So my goals may not match your goals. So just go into that, watching this video. Three, I think that it's good to kind of create this video because I'm getting close to being debt free, and I want to have like a baseline for what the video was, or not the video was, but like where I stood, when I became debt free. Like this is kind of like a starting point, like a timestamp to remember and kind of reflect back on later on, as I continue on with this journey. It's like, okay, this is exactly when I became debt free, and then going on is kind of like the progress I was able to make. And you probably should see a change in the trajectory trend, because it's no longer going towards debt and it's able to all go towards building wealth. So I kind of want to say that. Also, I want to make it very clear, this channel is strictly for entertainment purposes. I'm not a licensed CPA, CFA, CFP. So, take my journey and documenting with a grain of salt. Do not apply it directly to what you're doing. See what I'm doing, and then do some research on your own to see if it's something that you are interested in doing, if it fits what your goals are, your risk tolerance and everything like that. Talk to your own CFA, CPA, everybody like that, and make sure that this is what is good for you. Do your research. Please don't just carbon copy what I'm doing, because I'm willing to take the risk on some of the investments that I'm making, and I don't want anybody to broadly apply it to their own lives. I think that's very, very important to be upfront about, and everybody needs to understand that when they're going through theirs. However, I do think that this is, like I said in prior videos, we need to be very, very focused on finances, and we need to be discussing it with one another. That's kind of my point and purpose with this whole channel, is to share my journey and successes, my failures. People in the current can kind of watch and follow along with me. If people are watching this video 2, 5, 10 years down the line, and they're kind of like looking as what I was going through, they're able to use that as kind of like a case study, to where they can see what I was doing right, what I was doing wrong, anything like that. Like, oh, that happened to him because 10 years ago he did this, or 5 years ago he did this, and they're able to kind of reflect on that, say, okay, that was an issue, this is a way that we can correct it, and that sort of thing. So that's just kind of all the ground I kind of want to set before we get into this video. But I think I've covered up enough of it already as to what we're going to be doing in this video. There's a couple things I need to take care of before I get started on this video tonight. So I'll take care of those, and then when I come back, we'll start getting into all the details and all the fun stuff. All right, see you guys in a minute. All right, so let's get into it. We are on the main screen. This is pretty much what it looks like as soon as I log in. It's just kind of like this brief summary page. So right here, you're going to see how much I have in the 401k currently. The Roth 401k is $34,400. It's a decent amount, but it's not where I would like it to be. Dealing with all this debt that I had really kind of set me back. But that's kind of where I am at as of now. This is close of 729, which is, it's reflecting of the market that was today. Today was a really good day. Everything up was, over a percentage point. Dow Jones, NASDAQ, S&P. So we're looking pretty good there. So if you scroll down here, here's one of the tools here that you'll kind of see with other people. Like, everyone's always asking, like, how much do I need for retirement? That's like a common question that's always out there. So this is kind of a tool for that. It talks about your replacement value that you're building in your account if you were to retire at a certain age, at the pace you're currently going at, how much you're saving, your savings rate, and the rate of return that you're getting, where you're sitting at with your progress. So by the time I retire, which I believe the setting is 65 years on here, I would have a 96 income replacement by the time I retire. Now, I think this would probably increase as the years go on, because I'm in a pretty good fund right now, and as I'm saving, it'll continue to increase. So what it means by the 96 is that my 100%, like if I were to replace 100% of my income for retirement, I would have 6253. Like, that's how much I would have coming in each month. If everything were to play out as is, I would have 5977 per month paying out to me, and I would have a total of 871,305. This is my total contributions for the year. This is all year to date. 3,400. My employer has matched up to 1,700. What this is, in order, for these numbers to make sense, what I'm doing is I'm contributing 10%. That's kind of what it is, and my employer will match 50% up to 10%. So that means if I were to put in, 8%, they would do 4%. If I were to reach, if I wanted to get the maximum, which would be 5%, I have to put in 10%. And I think this is a proactive move on their part, understanding that the United States economy, like we're so far, behind as far as retirement savings, and I think this is kind of their initiative to try to get us to save more. Because if you were to save only 5% of your income and the company is matching 5%, so you're doing 100% match, not the 50% that we're doing. So it'd be 5% of 5%, so you're getting 10%, and they're realizing 10% isn't a whole lot. And some people, to get 5% is still pretty good too. Sometimes it's only 100% up to 4%, so it's 4%, 8%, and that's just not going to do it. People are getting closer to retirement age, and they're realizing they don't have enough in their retirement account. So I think this is kind of their move to get us to save 15% total, our contribution plus their contribution. I think that's what they're doing here. That's just my assumption, my guess, and I think it's a good move. I think 15% is a good number to hit, especially if you're not making six figures, and which I'm not, and it kind of takes everything into account. So I think that's, if you're hitting 50%, you're in a much better position versus if you're hitting 8% overall. So that's kind of what that is. I'm not doing any pre-tax. I'm doing 100% contributions to Roth. Obvious tax advantages there. It's huge. Everything is going to grow tax-free, and that's just huge, massive. So my, rate of return for the year is 11.84. Now, this is good or bad depending on what you're looking at. If you're comparing this to the S&P 500 or the Dow Jones, this is really good, because as you know, as of today, the Dow Jones has not bounced back completely yet. I think after today, it's down 3%, somewhere around there, I think. So for the year, and that's really bad. So if you're comparing 11.8% to -3, I mean, that's obviously a huge change and huge difference between the two. S&P is around break even. I think it's probably close to 2%, 3% right now after today's big day. So 11.84 is still much better than that. However, if you were to compare it to something like the NASDAQ, NASDAQ is up 17%, probably 18 or 19% after today. So it's doing really, really well. So if you were to compare this to that, it's underperforming. Most people are looking at the Dow Jones and S&P 500 though. So I compare to that. I think I'm doing pretty well there with my rate of return. Let's take a look at personal performance. So this is kind of like a little way you can manipulate on your performance over the years that you've been contributing. If I were to scroll down here, it kind of shows you what I am currently invested in. Your pie chart, if you will, of the percentage that I have invested. So I have the MFS International Diversification R4. I'm only contributing 5% to it. I had a rebalancing that I did, so it's not quite 5%, but it's 4.6% in here. And then the majority of my stuff is in the T Rowe Price Growth stock and the T Rowe Price Mid Cap Growth. That makes up 95% of my contribution will be going towards these two, because I know that they're really, really good performers. I'm just kind of experimenting a little with this MFS, and I am going to be getting into another video later on as to what my plans are with this and what I'm going to do with this, but that's going to be a later video. So anyway, if I scroll down a little bit further down here, I kind of see the progress in this fund for year to date. So obviously it was doing really, really well at the gate, and then COVID hit end of February, so that's kind of when things dropped off. I was continuing to invest all the way down, so I think I got in some contribution in here, and I got a contribution in down here, and then I kind of just invested all the way up, and it's just been kind of growing since then. As you can see, we get to 11.84. That was on the home screen. I get here. Investments made during this period is the 5,000, which is kind of in agreement with the beginning, which was the 3.4 of my own contribution, and then 1.7 of the employer. We have charges. These are record keeping fees on their part of the fund that I'm invested in, 23.74. They realized they overcharged, so they gave you back the 993. Market change, this is the increase that we're seeing. The gray line is kind of my contributions. That's like the net. That's what the net position is the contributions that we're seeing, and then the blue line above it is kind of like the value of the fund that it's in. So that's the difference between the net position and the market value that you see there is what makes up the market change. So that's just kind of what that is. Let's kind of look at the previous years. Let's see. If I were to let's look at a custom, because there's not I started in 2016 is when I first started, but because there wasn't a full year of investing, it doesn't give that as an option. So let's look at 16 that I was invested in, and then we'll look at, actually let's change, let's do 17, December 31st, and we'll look at that. So as you can see, I was invested into the target retirement date, 2055 for Vanguard, and we'll go a little bit into that later, but this is what it automatically enrolled me into when I was talking about in that video that I'll talk about up front, or link in the corner of my mistakes that I made, where I waited too long to really analyze what I was invested into. I'll put that link up above, but it automatically enrolled me into this back in 2016, and which really shocked me. I wasn't expecting it. I was just I was opting out each year, and then this year they just automatically decided to enroll. You had to actually physically go in and say that you weren't interested in order for it to not thing. And so that's kind of what this spike in the beginning is. This like a big growth. is because it was like full on 6% at that time before, and then I was in a blackout period where I wasn't able to make a change to my investment, so I was kind of stuck in it, and it hit two full contributions before I was able to move it. And the fund was already started, and I was like, well, it's already open now, there's no point in going to do all the effort to close it down, so I'm just gonna keep it, but I'm gonna pull it all the way down to like 1%, 2%. So that's kind of why you have like the huge growth at the beginning, and then it kind of like levels off very quickly. And so that's, you see very little steps. The contribution isn't very high. And then I got to the point where I was reaching 2017, and you see the steps are getting a little bit higher because my goal was to get to that 10% so I could get the 5% match. So that was kind of the whole goal at the end of 2016 and into 2017. You can kind of see that the steps are kind of the gray steps are getting a little bit bigger and bigger as I'm going on, and as I start to hit that stride of getting to that mark, you can see like the thing just really starts to take off as I'm investing more, which makes sense. Your money is starting to pile up, it's starting to compound more, and this is a small amount of time. Imagine as you're doing this over a 30-year time frame, 40-year time frame, it's really going to take off. So that was kind of my goal, is to hit that 10%. And I think I got there towards the end. I think around here is when I was starting to hit that 10%. I was hitting like 6%, 8% up until that point, and I finally hit 10%. And if you look at my returns over that time frame from early February of 2016 all the way to the end of 2017, I had a 37.59% return over that time, which is incredible for a target date fund, I think. And annualized, it's 18.25% return. That's fantastic. That was really hitting it off during that time. I actually didn't realize I was getting that much in the beginning with the target date fund, but still, in the end, I realized I wasn't in the best fund. I probably could have got a whole lot more than that, but hindsight is always 20/20. So let's take a look at how I decided to handle things in 2018. 2018, I didn't make the smartest decision. As I talked about again in the whole my mistakes video, I was talking about how I is it? Yes, this is it. How I wish I had used leverage a little bit more on the debt that I had. Well, this kind of applies here, because once I got to 2018, you don't see those huge steps anymore here at the beginning. You see it's very small increased steps, and that's because I realized that I wanted to pay off my car. That was the huge goal of mine. I wanted to do that, and I should have never done that. I should have just continued to stay on course, pay down the car as is. I was already locked into that car deal, so just get it done and over with, but continue to use it as leverage and continue investing money, because I wasn't getting the type of returns back then by throwing all the money at the car. I should have been throwing it into the market, because it would have just grown, increased, exponentially. So anyway, it was right around this time, end of July, when I paid it off in full. I think it was like I wrote a $3,000 check and just paid it off completely, and then I started to jack it back up again. And then down here you can kind of see the huge crash that we had in the market at the end of October. This was around election time when Trump became president, and we kind of saw a huge drop in the market, and everybody was kind of freaking out, wondering what was going on, and didn't know how long this was going to last. So you kind of see like that's kind of where the year finished, and we had the 10.52 negative is the return on the year. So I kind of wish I hadn't used that money again, like I said, to pay off the car, because I could have invested that into this huge down market. But again, hindsight is always 20/20. You live and you learn. So let's take a look at last year, 2019, which was a really great year for anybody who's paying attention. I mean, it was an unreal year. It just kind of took off immediately after the year was finished. Like that huge downturn that we had at the end of 2018, it just took off like wildfire. It just went up and up and up and up. And I was hitting 10% throughout this entire time. of contribution with employer match is 50% match. It was 15%, so it's really good. And as you can see here, for the year total, or the whole year, I hit 25.93. Let me do something. I want to make sure I don't get logged out. So I go back. I did filter 2019. So as you'll see here, I did have that really incredible turn of 25.93, but anybody who was paying attention to the market, I think the market hit somewhere around 33%, so it was better than this. Obviously, I would have had a much better return than this 25.93, but as you see here, I was still in the target date fund up until that point, which is crazy. I can't imagine what it would have looked like had I been in the different funds I waited to get into. So September 10th, 2019 is when I finally went into this whole fund performance tab up here, and I really looked at the options that I had available to me through this 401k. I had never done that before. I was just so focused on the contribution, I wasn't looking at what I was actually invested into, what my options were. So this was my first official change in this account when I rebalanced everything, and I threw it all into this into the Vanguard index that was available to me. It's whatever mimics the S&P 500. So this was, I repositioned to kind of put everything into this account, and then as you see later with this other triangle over here, I was able to rebalance in October 25th, so a little bit over a month later, realized I had an even better option when I was under that fund performance and started really diving in to look to see kind of what was available to me, see if I could get an even better return. And sure enough, I found an option I was, and so I moved everything over to that. And then obviously I moved it over to the the mid cap growth and the international diversification as well. It kind of took everything, did everything at that point too, moment of time to reposition everything. And as you can see, it kind of really started, there wasn't a whole lot of time left for this year, but even after that change, you can see it really started to take off. So I should have been in this fund since 2016, but like I said, I wasn't being smart with my investments. I was looking, yes, the most important aspect of wealth, as they've talked about in other studies, is just your contribution rate, but you can double dip and get the best of both worlds if you have a good contribution rate and you have a good fund that you're invested into. It's just a little bit of everything. So once I moved in there, it was just like, it was amazing. I was so glad to move in there. And this 25, I probably would have been closer to 35%, 36% or whatever. It would have been really nice to get on that, but better late than never. So everything looks good, and from micro aspect when you're looking at this year to year and you kind of look at the graphs. But let's kind of look at this whole thing from 2016 all the way to current day to kind of really see how my decision making impacted the chart as a whole. So if we look at this all, we're able to see just like really how things were affected, right? So I start off and I immediately took my contributions down, even though I had a really good trajectory shoot off in the beginning. You kind of see like everything kind of plateau out a little bit, going really small, and then I have that huge growth to hit 10%, right? Like all throughout 2017 all the way up to 2018. I really wanted to get to that 10%. So you really start to see that curve start to build, just even with 1 year, just trying to hit that 10%. I mean, imagine if I hadn't become so stupid to lower my contribution limit, to focus on paying off the car. I mean, look how much I just killed the momentum here just by changing that to pay down a car. Like, imagine if this had just kept going up and going up and going up, at the rate that it was going. I mean, just killed all momentum. I just really should have been investing into this, and I wasn't smartly handling my cash at that point. So here's around the time that the car was paid off and he started investing again. It looked really bad in the end of 2018 when after Trump was elected, and we had that crash at the end before obviously took back off in 2019 to start the year. It looks like nothing here. It doesn't look like anything really even happened. So everything is always panic at the time, but when you step back and look at it, it's like, oh, it's not really that big of a deal. So again, still in the target date fund, and going up and going up. I finally moved to Vanguard. Does pretty well, and then I move over to this other fund, and man, bam, it just takes off. T-Row. As soon as I do that, it's just really taking off. It's cooking with grease, and it's just really doing me wonders. And then obviously COVID hit, and that's kind of when everything dropped down. Obviously, this decline was one of the fastest declines we've seen in the market since, I think the Great Depression. So it's just really drastic and extreme, but as you can see, it's really bounced back with a vengeance. At least this fund has, not really the S&P or Dow Jones like I talked about earlier, but at least this fund is really taking off. And over this entire lifetime, I've had a 75.6% return. You break that down, year to year, you get 13.39% return, which is good. I'll take that. No problem. Even with fees, even with the T-Row that I'm in, I don't think my expense ratio is over 70 basis points. So I should be doing really well there. Even with that, I mean, you're still outperforming the market, bar none. So I'll take that 13%, no problem. And I'm just saying, now that I am in this T-Row, I'm really excited to kind of see what it can do, the damage that I can do, especially with my contribution rate being 10% and the employer match of 5 to get that 15%. It should just really, be incredible to watch. So I'm looking forward to that. Yes, I am a little worried how this market's going to be, with the forbearances, coming due and everything like that. And wondering how this, second wave of COVID is going to happen, if we're going to get anything more extreme, people losing their jobs or anything like that. So I'm watching the market, but I'm proceeding with cautious optimism as to the potential that this has, even if it's not short term, more of a long term view on things. Let's go to the fund performance, because there's a couple things to cover here and talk about. Like I said in the beginning of the video, this may not be for relatable to everybody, because everybody's 401k is different depending on the way that their company has set it up. So this is kind of what I have available to me. The scroll bar, as you can see over here, is pretty long, so there's a lot available here. Now, not all of this is stuff I can invest into. Some of this is just to use as a comparison, and to compare how the other markets are doing. So anything I can click on or things I can invest in. So that's kind of where I'm at. As you can see right here, I got the green check mark. I'm in the T-Row price growth stock, and it kind of gives you everything here. You have large growth, you have large blend. This was the Vanguard that I was in before, was the large blend. Now I'm in the large growth. And then you have the Vanguard equity. So these are the only 3 funds that I have available to me that are large company. And then these are all the stats and everything like that over there. And I'll go. There's a lot to go in on this chart as it is. It really does need its own video. I mean, I can talk about this stuff for an hour easily. So we will go into a more further deep dive. But I don't want that to overtake this video. So this is just more of a walkthrough, what I'm looking for, things that I evaluate and look at and monitor. So that's going to be this video. That'll be another video, but that should also be another interesting video. So then we move to small mid cap. Small and mid cap is going to be one of those ones where we have more available here as compared to the large company that's above. You have your mid cap blends, you have your mid cap growth, you have small blend, small growth, all down here. The mid cap growth is the one that I'm currently in. That I made, I think, after the second rebalancing, after I moved out of the Vanguard completely. I kind of want to diversify, mix things up a bit, kind of an upside play here. So these are all that I have available to me here. Then you have your international global, which is why I have the MFS diversification down here. It's the 4 large blend. I will talk about my plans for this in another video. That'll probably be in another video of itself as well, kind of what my plans are with that balance. This is what I was in, this is like your target date balance funds. Like as you get closer to your retirement date of this year, blah blah blah, we will adjust your portfolio percentage wise. Like we will give you more bonds as you get closer to your retirement age, and less stocks to just kind of conserve your capital and or preserve it, not conserve it, preserve your capital, and make sure that you're not over risking your portfolio and your hard-earned money. But it just wasn't performing the way that I like, so I quickly moved out of that as soon as I saw that I had better options available to me. And as you can see, there's I do have a large scroll bar of options available to me, but a ton of these are target date, which I have no interest in whatsoever. All these I would not be investing in anytime soon. These bonds here are another option if you want to get into bonds. Again, even more so than target date funds, I will not get into these bonds. Just not of any interest to me whatsoever. So I just skip all these options that are available to me here. Then you have capital preservation, which, same category, would not be interested in these whatsoever. So the mass majority, I think I have like 35, 36 funds available to me that I can pour cash into with my contributions. But again, like maybe 80% of these, 90% of these I wouldn't even consider using. So just because the rate of return isn't that attractive to me. So everyone's like, well, you have so much more that you're available to invest into than me. It's like, yeah, well, how many of those are actual options that you would be interested in? It's just not for me. Okay, so let's look at, obviously your history statements up here. This is kind of where you can pull to find out where your contributions are, like how much you're coming out each month, how much you're going into, like what it's being invested into. This will also show you your fees and everything like that are being pulled out, your maintenance fees and cost. That's there. Let's go back to overall. I want to show you guys something that I think is pretty cool, which is kind of like a playment off of this whole the tool at the beginning of your are you saving enough for retirement. There's a really cool feature up here that I like to look at and review. So these numbers are kind of projected based on the information that I have plugged in here. I don't have anything here, but it's the 10%, so it's going off 10%. If I were to increase my savings rate, you can kind of see how it changes the numbers. I don't foresee myself going above the 10% because it doesn't do me any good to continue over 10%. Just because I'm not getting much more of a match from my employer. If they were to match more, then yes, absolutely, I would throw more money at it, but it's not. So right now I'm having a bit of a internal conflict on asset allocation and what I want to do there. So I know that I'm going to hit 10% here because that's just the magic number. I want to be able to max out the Roth IRA once I open that up, and that'll be pretty soon. I'll be opening that. So I want to be maxing that every year. It's only $6,000, so it's easy to hit that, and then hit 10% here, and then everything else I'll be able to figure out what I want to do with. I'll probably have a separate retirement account that, or at least a separate investment account that I'll be throwing money at, because I want to get into a house soon, and the money will be saving into that. And then after I buy the house, then I can reevaluate my position and say, okay, do I need to continue throwing money down into the separate retirement account or a separate investment account, or reevaluate this 10% that I'm using into the Roth 401k? That's just kind of things I need to think about. But that's 3-4 years from now, so I'm not too concerned with that. I'm just going to hit the 10%, just keep plugging away on saving money. Again, if I have a planned retirement age, if I were to change that 65, it would obviously drop the value. 62 is the earliest. If I had later dates, it would change as I go. So I just leave this at 65. I don't plan on retiring at 65. I plan on retiring much earlier than that, but it is what it is, which is why this is not to be looked at as like a broad brush stroke evaluation. This very, very vanilla. Everybody's going to have a different outcome or wants or desires. Social Security is also being calculated in this. I don't think I'm going to have Social Security by the time I retire. If I do, excellent. If not, that's fine. I'm not living my life in expectation of this. I'm trying to rely on myself. I don't care what else is out there. If I can take care of myself and not have to rely on anything outside, I'm going to be good. And as you guys have seen in some of my other videos, I'm going to be very good. So I'm not too worried about needing and relying on Social Security. Okay, so here we go. Measuring up to the peers. This is kind of the cool tool that I was talking about. this kind of puts me in viewing kind of where I sit amongst my peers in the US. I'm a very competitive person, so it's kind of cool to see how much you can improve and increase, and it also allows me to see just like how far behind I am, how much catching up I need to do. Now, obviously, I knew I had to do some catching up. I already knew I was behind because I was already paying off debt. I had so much debt and I was paying it off, and I knew I wasn't putting money into investing like I should be in retirement. So I already knew coming in that I was going to be, fighting an uphill battle a bit. So anyway, how it does your comparison is it takes your year, and it does plus or minus 2 years to that to put you in a grouping of your peers. And then it also says, okay, people within that age range who make, in a range of 56 to 62,000, plus or minus 5% over what your salary is. So it's kind of looking for this. And these are all the people who have Charles Schwab accounts who they're able to pull data from and just kind of see how you live up to those people. Now, people in New York in this area up here will have more money than me, obviously, because they just make more in those areas, but also they're, same thing in California, but also their cost of living is much higher. So, it kind of evens out. It's kind of hard to really say the impact on that. Really, everything's case by case, so it's hard to say. But anyway, this is kind of like where my peers live, or like kind of where they are in relation to me. But if I were to look at my rankings versus the peers, which is a cool thing, I can go to income replacement here. And right now I'm at a 94th percentile, which I think is pretty good. Even fighting an uphill battle, at least I was putting something away instead of just putting all my money towards debt. Like now I'm in a position where I can really do some damage because I didn't just throw money at debt. I was actually building some wealth up beforehand. So right here I'm at a score of 96% of my replacement value. I've already seen that through the homepage, but 94th percentile. This has kind of changed as I continue to, I didn't realize that I can change my salary. So once I decided I was changing my salary every year, I thought it was doing that for me already, but I had to change it. So last year, November, I think I was 94 percentile, and then I updated my salary to what it was last year, and it bumped me down to 94%, and then I bumped it again this year after my raise, and I was down to like 92%, I think, and now I'm at 94% after obviously the bounce back that's been happening for this year. It's bumped me back to the 94%. So if I get a raise again next year, I'll update it again. Just continue to track this. I on my sheet every month. I'm always upgrading to kind of see if I'm making progress. Am I not making enough progress? Just kind of see how I'm doing. And also with this, there is an option to put in like the Social Security that's on there. I could delete that to not include that at all, and it would affect my numbers, but I'm just going to leave it for whatever. I have an ability to put in outside savings as well within these number projections, and I don't know if changing those numbers will affect these numbers at all. I don't have any outside savings that I can account for, so I haven't changed that yet, but I do. Once I open a Roth IRA and start contributing to that, I'm going to change those numbers and see how that skews the data, and see kind of where I'll stand at that point. So I'll be curious in seeing if this will just be something for me to compare in my 401k to my peers, or if it's just my savings as a whole. It'd be kind of a cool tool to get it all together, but we'll see. So anyway, my current balance, this is one that I've seen a big change in. Before I was 74%. Again, I'm playing from behind because I have all this debt. So I was at 74% in November of last year, and then I changed my salary and it went down to like 96, I think. And then earlier this year when I changed my salary again, it was down to 72, and that's also the combination of the market crashing a little bit as well. So it was down to 72, but now you can see like it's bounced back in a big way to the 79th percentile. So I've really done some damage, and I'm really trying to bounce back and monitor this. So I'm really happy to see that, and it's just because of my returns, I think. It's also because of the savings rate, because I do have the 10%. As you can see, it puts me in the 92nd percentile among my peers, and that's pretty good. I think that's going to allow me to hit my income replacement, really grow my balance, to really catch me up with my peers. Is because of the savings rank. Now this is something that I think I was in 93% last year, November, and then I updated the salary in December of last year and went to 94, I think. And then this year happened and I got another raise and I updated again and it bumped me down to 92nd percentile. And I kind of thought about that. I said, wait a second, is that right? And it makes total sense to me because I'm making more money, and just like my peers are making more money, it's putting me in that threshold. So they're able to save more because they're making more. That's kind of what I look at it. Now I'm capping myself at 10%. Could I hit this 15 plus up here? Absolutely. And I could probably put myself in the 100th percentile, but that's not what I'm looking to do. So I'll probably just have to be happy with this 92 percentile, and it'll probably continue to drop as I get older and everybody's making more money. My peers are making more money. I'm making more money. So that's kind of so what I'm probably going to be looking more into is the current balance. Like, this will probably be the most important thing out of all this. Income replacement, I don't care about the 96% because I have different goals and aspirations. Actually 96% should actually probably be more like 70% because I'm looking to save much more than that. So this has no idea of my goals and aspirations. So I ignore that completely. Savings rate doesn't matter too much outside of it just being 10%. Current balance is everything that matters to me. National comparison, this is kind of cool. It just kind of lets you know where your current balance ranks, your savings rate, and your income replacement score is state to state. So it's kind of cool to look at, just to kind of see like, oh, how I compare with Montana or Wyoming or whoever, and just kind of see where you stand. Industry comparison, this is like, hey, my peers who are in the professional, scientific, and technical services industry, that's where a lot of my peers are. Manufacturing are here, finance and industry, and it's kind of like, hey, this is kind of where their savings rates are at. This is where their average, the median savings rate is at. Obviously I'm at 10, so I'm above everybody here, but again, this is the median, not the average. This is the balance that they have in their accounts. People who are in the mining industry have the highest balance, which is interesting to me. Makes sense for finance to have such a high balance, but the people in mining are pretty aware of their standing, I guess. Income replacement, this is kind of where everybody's standing here. So it's just a really cool tool to see some transparency in the country and kind of see where things are. Anyway, this video is going on and on and on. I could tell you talk about this stuff all day, but again, this is just me being completely transparent in my finances. Just sharing all this with you guys. If you're viewing this 5 years from now, 10 years from now, you can compare with what those videos look like then and kind of see where I really come from. The tone, the savings rate, like, okay, this is kind of where I stood and everything like that. And I have no problem sharing the amount of money that I have. I know it's taboo and people don't like talking about it. It's like, oh, it's private, that's a personal question. It's like, I don't care if people know how much money that I have. It's or how little, it's just like, if it's so little that I could do something about it, and I am working on that. So, which is why I only have 34,000 versus like, I should probably have 100,000 at this point, but because I was dealing with debt, I didn't know about money early on. I'm playing an uphill battle. So it's just like asking me what my favorite food or favorite color is. This is, it doesn't matter to me. So what does matter to me is me sharing this information to people, because if it's beneficial to one person or two people or five or whoever, like, then I want to share it. Like, I think the most important thing that we own is knowledge, and if we can share that with one another and make each other better and provide them with a better means of living, then why would we not share this information and help each other out, through, we can talk about theory and strategy all the live long day, but until you're actually applying it and doing something with the knowledge and your theories, then it's just a piece of paper at the end of the day. So anyway, sorry to get all philosophical on you guys there, but just kind of where I'm at, and I'm gonna get this video edited. I was really excited to get this video out. There's other videos that I'm super excited to get out as well. Hoping that this video was somewhat informative to you guys. Maybe you learned something. You learned something that is good, learn something that's bad. You know, I talked about kind of some errors that I had in here, some things that I did good in here. Again, I don't know everything. I sure as heck don't know everything. I do some good, I do some bad. We can all learn from that. If you guys enjoyed this, leave a like, hit the subscribe button if you're new to this channel and you kind of want to follow along, kind of see what I'm doing and kind of how everything is playing out, and use me as like a case study. That's excellent. I'd really appreciate it. Maybe share it with someone if they're having some difficulties in how they navigate their 401k, or what to look for, what to look at. That'd be cool too. Also, comment down below, how many options do you have available in your 401k? Do you have as many options as I do? Do you have fewer options? Do you have better options? Or do you getting pretty good returns on your stuff that you're investing in? Or are you getting low in returns? Is it pretty complex? Is the interface on your website, you know, within your 401k pretty cool and fun to play with, and very modifiable, and you're able to explore within it? Kind of leave a comment down there. Let's start a discussion down there. Anyway, I've talked enough. Thanks y'all for stopping by, and be looking for more videos in the future. Bye.